Hey guys, what's up? In this video, I will be doing a first pass at explaining my trigonometry day trading strategy. I know it might seem very unusual to you, and day trading by itself probably seemed far out there enough without adding all that extra complexity, which I'm trying to explain in this video. If anything is unclear, please let me know in the comments. I'll just treat this video as kind of like a rough draft before making a more polished video in the future. So with that, let's just get started. So I think for those of you who are beginners at day trading, or maybe you just clicked on this video and you know nothing about day trading, haven't placed a single trade, or whether you're an advanced trader, I still feel like you'll get value out of this video, but we'll start with those of you who are just beginners. All right, so if you're starting from the very beginning, let me explain the basics, okay? So in day trading, you need to trade an instrument, and an instrument is either it can be a stock, it can be crypto, it can be like cryptocurrency, which no one trades these days, whatever. It can be Forex, FX, which is a currency exchange. It can be futures. I think those are the main ones I've heard of. Now the one I do is foreign exchange currency. So when one country's currency is trading lower or higher than the other, that level fluctuates, and then so traders can take advantage of that difference. And now what a stock is, essentially you own like a very small part of the company. So you buy one share of Apple, you own like 0.00001% of Apple, and obviously the largest shareholders of Apple would then be the CEO Tim Cook and some other people on the board, or some other large company. It would be the same story, like Jeff Bezos owns most of Amazon, Mark Zuckerberg owns most of Facebook, and so when you buy a stock, you get to earn like a very small portion of that entire company's funds. And if the company does well, then its stock goes up, and more money then flows into the company. If the company does bad, the stock goes down, and so the company loses money. So the stock then acts as kind of like a performance metric of how the company is doing for those companies that are publicly traded. If you're a small business, you would not have an IPO, so you would not be traded publicly. So you would just be doing like your business in the community or something if you were a small business. Now I'm sure a lot of you might have heard of crypto. It used to be a big thing a few years ago, even 2021. Then the whole crash with FTX happened, and then people found out that a large part of it was fraudulent, and no one's really talking about Bitcoin anymore. But at one point, people were thinking, it's going to go to the moon. Right? Rocket ship. But these days it doesn't look like it's doing a lot. No one's really trading it. It's up to you what you want to do. I started actually trading something else that is not on this list. It is called an index or indices, plural, or an index. Now, an index is basically a basket of stocks that are also weighted within that index. So, for example, the Dow Jones, also known as the US 30, has the top 30 stocks in the US that are weighted inside of that. That include, I think, McDonald's, Walmart, Berkshire Hathaway. I couldn't name all of them if you asked me to, and it's not really my job to do that when I'm trading that. But just know that an index is basically like the average of the largest stocks in the U.S. There's also the S&P 500. There's the Russell 1000, I think. So, but the point is, it doesn't really matter what you trade. I just chose to first trade the US 30 because it was volatile and it was highly traded. So when you're looking for something to trade, you need to look at liquidity. This is known as liquidity. It means that a lot of people are trading the same thing, and so when you buy or sell it, then the price that your order is executed at doesn't slip a lot, and it's called slippage when, say, you want to buy it at 1, but actually the order gets placed at 2, so that is a worse price. And if there are a lot of people in the market, you buy it at 1, and then maybe it gets filled at 1.01, which is not a lot of slippage. So first of all, you need to look for liquidity in it. Second of all, you need to pay attention to the times where it's traded. So maybe most of you who live in the Eastern time zone, and that's why the Dow Jones might be good for you to trade, because it's most active when people are awake at that time. And we call this the New York session, which is from 9:30 a.m. to 12:30 p.m. I believe, which is when I used to trade. Wait, no, I'm mistaken. Okay, so it's 9:30 a.m. to 4:30 p.m. Actually, it's when the markets in the Eastern time zone open and when they end. So you're looking for a convenient time, and I suppose the third thing you're looking for is volatility. Like I said, volatility. Okay, so you want an instrument that is able to move a substantial like up and down movement. You don't want something that is flat, right? Because you're not going to make money that way. If you have something that is like substantially up and down, what did I just do? What's that? Nope. No, thank you, Microsoft. Just give me 1 second, sorry. Yo, can you actually not, Microsoft? Dude, what the hell is this? Sorry for that. Anyway, as I was saying, we need volatility, right? So if you have very wide, up and down movements, then you get more opportunities. You can buy here, and then it goes all the way up, then you exit here. You can sell here and then buy here. That is what is known as shorting the market, and you would also make money that way, right? Dude, can you actually... This thing really needs to go away. Just bear with me for 1 second, sorry about that. Anyway, that's another thing, okay, placing orders. So when we say buying something, that is known as longing. That is known as going long. I just say longing for short. In other words, going long, okay? Same thing, just some fancy terminology, because we want to distinguish the order in which we do things, which is why if you go short, that is the same thing as selling. Now, I want you to think of selling and buying as independent events. So that means you can do any in any order. So you can buy first, you can sell later. That is going long. Okay, you can sell first and then buy later, and that is called going short. Either way, if the market moves in your direction, then you make money, right? So that is going long here, and this one is going short. Don't ask me why there's terminology. I suppose it just clarifies that it's independent of the order. So no one's confused when you say what do you have to sell? Essentially, when you're going short, you're borrowing capital. It's automatically a leverage position, which means you're borrowing capital, and then you're taking someone else's buy order at the bottom. So your platform might have margin requirements, so that you can trade on leverage. You can trade with more capital than you have. So how do you sell something that you don't have? Well, you have to borrow it first, right? So that's why going short is known as margin trading or In other words, trading with more money than is in your account. Okay, so I won't really go through technical requirements in this video, like how do you actually get started. I'm sure a lot of other videos on YouTube clearly can explain that, but essentially you need a platform in order to place trades, also called like a broker. A good one I recommend if you either live in Canada or not in the US is CMC Markets. Their commissions are low, their sign-up procedure is simple, and they have a lot of instruments to trade at good margin levels, and they have good spreads, which means there isn't slippage, which means, like earlier I mentioned, you need to get in at an optimal price. You need to get in at the price that you asked for, and they're good with that too. So that's what I recommend. Once again, it is called CMC Markets. Of course, feel free to explore your own, but that is what I currently use right now. So let's just get into my strategy, alright? So in day trading, there are two ways of assessing how the market is going to move. Number one is called technical analysis. And number two is called fundamental analysis. So first I'll actually explain fundamental analysis. Fundamental analysis is looking at a company's health and looking at its performance statistics and metrics in order to make your trading decision, and also whatever news that comes out about that company, whether it's positive or negative, you could see on Twitter or you can see in trading groups. That is all under fundamental analysis. So what that means is it covers news. It also covers how the company is doing in general. Like I said, if the company is doing good, then it's going to go up. If the company is doing bad, it's going to go down. That's in terms of stocks. In terms of Forex, which is what I currently do right now, you would be looking at geopolitical events. So if there's tension in Europe, so like for example the Euro USD, this is the Euro being converted into the US dollar. Say there's tension in Europe, the Euro goes down while the US dollar is still strong. Just treat it as a fraction, right? So then it's like 1/2. This is half. Then it's like say 2 increases to 3, right? That's how you know. Then this would be going down if the Eurozone is doing bad compared to the US dollar. Obviously a very simplified example, but you get the point. If, like, say the US is doing good now, okay, so that explains fundamental analysis. So now what is technical analysis? Technical analysis is looking exclusively at the price and its movements and trying to predict something off of that. So that includes patterns, that includes support and resistance, supply and demand. We're going to get into all of that, okay? So, like I said earlier, a stock or a certain instrument can make waves like that, right? It's almost like random movement. It can, it can go straight up, it can go straight down, it can move in waves like that. It can, channel up like that. It can also channel down like that. It can do all sorts of things. And this is what is called, I suppose you could call it like randomly modeled. So you could compare it to like the weather or something, or you can compare it to like atmospheric noise, or you can compare it to things in nature that don't really follow a set pattern, but that kind of move anyway, that create these movements within their chart. But the thing about the movement of stock prices and other instruments is that psychologically we're able to predict the next movement to a certain degree of accuracy based on what came before. So that means that, let's say, your stock price, or whatever it may be, I'll just call it price. Let's say price does this, okay? It's going down, down, but it reaches a bottom. It reaches this bottom here, and what does it do at the bottom? It refuses to go down anymore. Now it's going sideways, and then all of a sudden, it switches directions and then starts going up. Okay, so we shifted from a downtrend to an uptrend. Now, what happened in between? This kind of like flatlining motion here. This is what we call support. Support. This is when like people were selling before. There was a lot of selling pressure. Then buyers came in and stopped them from selling more. And then at a certain point, like the buyers outweighed the sellers, right? The buyers outweighed the sellers, and so it shifted in the buyer's favor, and so that is what drives the price to move upwards. Now let's look at the opposite of that. The opposite of that would then be resistance. So this is the case where people are buying it, there's buying pressure, and then all of a sudden it's flatlining like that, and then the scale tilts in the bear's favor. So by the way, it's called bullish when a lot of people are buying it. It's called bearish when a lot of people are selling it. And so once again, this is upwards movement that gets stalled out at the top because there are more sellers than coming in, and this is what we call resistance. Resistance defined as the flatlining motion in between the upwards move and the downwards move, and then the bears take control, people start selling it, there's selling pressure, and so that is what drives price downwards. So we have support and resistance. Now these are very fundamental concepts to technical analysis, okay? So I'm just going to start by explaining these most important concepts. Now, how do you exactly identify what counts as support? Now this is where we come to the central problem here. Now if you look at your TradingView or charting platform, I like to compare it to, let's compare it to geography, all right? So you are one person. You're one person in your room, in your house, in your neighborhood, in your town, in your city, in your province or state, in your country, in your continent, on planet Earth, in this galaxy, in this sector of the Milky Way. Okay, you get the idea. There are different kinds of resolution we can apply to one person. What is their location? And the same way we can say that actually price is the same way. If you zoom in on price, we have what's called different time frames, all right? So on the 1 minute chart, the 1 minute chart looks very different from the daily chart, right? The daily chart is basically tracking the movement across the day, and they summarize that with a candlestick. Now, I won't explain what a candlestick is really here. Again, there are tons of other videos that do that, but essentially, right, you got the open, the close, right, the high and the low. Now, this is the candle that is printed every day on the daily chart. So you have day 1, day 2, day 3, and you could get it like that. I wonder if I can change the color at all. That'd be cool. Can I? Right? You got this. Oh, that's clearly the wrong color. Probably should have figured this out. Never mind. Okay, let's just do black and white, okay? Why is it purple? Never mind. But you get the idea, right? Apparently, select again for more options. Okay, there you go. There you go. So, right, we got these candles printed, right? You can have a bearish candle, and then you could have a green candle like going up. So this gives you information about again, like day 1 and then day 2 and day 3 and so on. Now what happens on the 1 minute chart is the changes that price will do on a minute to minute basis. So we have minute 1, minute 2, minute 3. And you can also have a very different motion compared to the daily within the 1 minute. So like I said, let's use that analogy. So what happens in your house is very different from what happens on the continent in general, or even in the country, right? But what happens in your town, starts affecting maybe your country a little bit more, or the other way around, right? Your country is more similar to the state than it is to you in your house. Hopefully that makes sense. Like, it's kind of like, how much does one affect the other? How much is one similar to the other? So once again, the 1 minute chart could be going up. The daily chart, could be going down. Or let's take the time frame in between, right? The 4 hour, the 4 hour, or even the 1 hour, or the 15-minute chart could all be doing different things at technically the same time. Different things at the same time. Technically, it's just a different resolution of information, because we can only summarize the daily as 1 candle per day. We can only summarize the 1 hour as 1 candle per hour. We can only summarize the 1 minute as 1 candle per minute, and so on and so forth. So we have one of the most important questions we're trying to answer here. How do we reconcile different time frames? I'll just summarize with TF, okay? How do we reconcile different time frames if the price is doing completely different things at the same time, depending on what resolution you look at? How do we reconcile that? And then let's look at question number 2. Now, some of you might know technical analysis. You might know all sorts of patterns. You might know you're both triangle, you're bull flag, you're bear flag, you're shooting stars, rising stars, marching soldiers, right? All types of patterns, right? Double bottom, right? Head and shoulders. And I'm not arguing that these patterns are invalid. I'm just arguing that they are actually kind of rare to see like a perfect pattern like that, and also that they actually have a significant chance of failing. They probably work more often than not, but it's very hard to see in the midst of one pattern whether it's actually going to form the pattern, or whether it's going to not form the pattern and just fail it. All right. So in my opinion, patterns are unreliable. My strategy does not rely on memorizing 50 patterns. All right. That leads me to question number 2. So if we take support and resistance, right? If we take that support and resistance as two of the most fundamental concepts in technical analysis, that is once again a shift in pressure, a shift in either buying pressure to selling pressure, or a shift to selling pressure to buying pressure. And in another word, you could call this technically is just a reversal, right? A reversal. So if we take reversals and support and resistance, some others might actually call it supply and demand too, but I personally think supply and demand is actually quite related to support and resistance, because it's not often that you see that price would just go straight down and then go straight up like that. Some people who talk about supply and demand kind of make it seem like it does that, right? It just touches and then it goes up. I don't think it works like that. You would see support being created more often than not and then going up, or in this case, like resistance being created first and then going down. It needs time to actually do that. For the straight down and up motion is actually kind of rare in my opinion. So for all intents and purposes, we'll be referring to supply and demand as just resistance and support as well. So support and resistance, I like to shorthand like that. Okay, so given the importance of support and resistance, how do we quantify it? How do we quantify it so that it is predictive and so that we don't falsely identify support as resistance or resistance as support, or somehow it's actually a trend, and then we mistake that for support and resistance, and then we get faked out. Like, how do we know the difference? Because once again, there are different market states. There is not just support and resistance, but like I said, like when it goes up, this is essentially a trend, and then there's the consolidation period, which is not trending, and then there's the trend down, and then this is what creates the entire sequence of going up, stalling, and then going down. Okay, so altogether you could say there are three market states. Okay, but I guess the question I'm trying to get at here is, how do we reliably identify market states being support or resistance, aka consolidation, or trend up or trend down? How do we identify the strength of that? How do we make sure it's not a fake out? How can we put a word to a number? How can we assign a number? What is the strength of this support? What is the strength of this resistance? What is the strength of this trend? And how do we do that across time frames? Okay? How do we reliably identify? I'll say, how do we reliably quantify and identify market states? Because you might say, oh, I just look at the chart. I'm a discretionary trader. I actually don't use spreadsheets. I look at head and shoulders, I buy. I look at double bottom, I buy. That might be your strategy and it might work for you, but I'm a guy who actually wants to look at numbers. That is like way too wishy-washy in my opinion. Like, at least for me, like my brain would start to play tricks on me. It would start to identify double bottoms where they're not even there. The markets are very messy, right? So it would start seeing patterns that are not there. And it would just, I would just start buying and selling without a good reason. I would be confused by all the different patterns, right? I can't really rely on my eyes. I have to rely on the numbers. And so, let's get that question there. So how do we answer these two questions, okay? So first of all, to answer question number one, the answer is to look across all time frames. All time frames. The ones I use are all the way from the 5 minute to the 2 day. Now, you might think that that's actually a lot and it might be too time consuming for your analysis, but I'll show you that my analysis procedure actually does not take that much time. And it doesn't, because it takes advantage of the fact that things can be chained together. So what do I mean by that? You don't need to take every single time interval, okay? So let's say you have the daily and the 4 hour and the 1 hour. If you do an analysis on the daily and you do analysis on the 4 hour and on the 1 hour, you actually get two analyses here. And you can also look at, you can compare. So once again, this is I suppose we should back up a little bit. Okay, I'm going too fast. Okay, so let's actually start with the second question. Sorry, I'm not being clear. Let's start with the second question. How do we quantify it? Okay, so once again, the definition of support. Let's take that. Okay, so the downtrend, then consolidation, then the uptrend. This is support. All right. Now, how do we define? So let's say we're looking at only the first motion and the second consolidation here. How do we define this in terms of the time frame? Now, if you look carefully at the chart, if it goes down and then it goes flat, in this instance, we would actually say the second move makes it so that the lower time frame is more bullish than the higher time frame. So what do I mean by that? This is the higher time frame here. I'll abbreviate it like HT, and this is the LT, the lower time frame. Now, why is this the case? It's because on the lower time frame is the most reactive to the smaller time interval. So let's say the lower time frame is the 5 minute chart. The higher time frame is then the 1 hour chart. So the 1 hour chart has not had enough time to react to what the 5 minute chart is doing on the lower time frame. So let's give an example, okay? Let's give an example. So say your 5 minute candle, is doing this, okay? So, but by the way, the clock is ticking while all this is happening, okay? So let me just try to explain this clearly. So the 5 minute candle first is a bearish, like a bearish body with very, very small wicks like that. Okay, so that's how the candle forms here. So assuming this, okay, and then we can say that so once again, this is going to be the 5 minute candle, and then on the 1 hour, let's make it so that the 1 hour candle is a spinning top doji that goes like this. This could very well be the case, right? Any combination you can think of is possible in the markets. So this is a spinning top doji on the 1 hour candle. Now, as time ticks and ticks and ticks, this is what happens. So 5 minutes have elapsed, and then now this 5 minute candle then it transmorphs. It morphs into something else. Okay. Now the 5 minute candle price has actually gone upwards. So say this is the support here. It has gone slightly upwards, but we still call it support. And actually that is stronger support if it's tilting up. So now that the 5 minute candle is then a dragonfly doji like that, which is a bullish signal. It shifted from a bearish body, and then price is essentially like it opened there, then the open then became the low here. The open pushed it all the way up to the high of that candle, and so it morphed into, as time went on, it morphed into this dragonfly candle here. But on the hourly, the change is smaller. The change is smaller because the price movements on the hourly are actually more volatile than the 5 minute. So on the hourly, this is all you see. Your candle has now just grown by that much, whereas the 5 minute candle had a more chance to react. It was more reactive to this price movement. It went all the way from from this bearish body to now this bullish candle, and maybe even more, right? But still, on your hourly, that's not much of a change. The hourly did not change that much. It just became like a little bit more of like a bullish spinning top, or if at first it was like it was a bearish spinning top, now it's a bullish spinning top. But I hope you see my point. The lower time frame is the first to react. And then it's kind of like a domino effect. It ripples throughout the time frames until the effect is seen on the highest time frame. So we can assume that the changes between time frames happen at different paces, and they're not completely random. I might have made it seem as completely random, but no, they're actually one change that is rippling throughout the time frames, and that's what my strategy tries to capture here. So once again, let's take that example. We have then the 5 minute. I'll do it in black. We have the 5 minute versus the hourly, and by the way, we know that actually no. Let's take this example. Okay, that was just for illustrative purposes to use the 5 minute, like to show how different it is from the higher time frame. But actually, in my analysis, we say the lower time frame is maybe 4 to 6 times smaller, or like shorter than the higher time frame here. Okay, so you know that like 4 15-minute intervals go into 1 hour. I'm gonna get into exactly what time frames I use, but just know that. Okay, so why is it 4 to 6 times? It's because that's enough to that's enough for the formulas in my strategy to capture what is the differential between these two without being too different and without being too similar, if you get what I mean. So for example, the hourly and the 2-hour chart actually look very similar, right? That's too similar. Whereas if I'm trying to use the 1-minute chart versus the daily, well, now that's too different. Now the difference is meaningless as well. So that I found that's a sweet spot. Okay, 4 to 6 times. Let's just use that example from now on. So the 15-minute versus the 1 hour. Okay, so now we know a valid and quantified definition for support. It is that the lower time frame is more bullish than the higher time frame. This is flatlining. You see that this is flatlining, but compared to that previous bearish trend, it is actually more bullish, right? Of course, if it does this, tweezer bottom, tweezer top, obviously that's very bullish. And now the differential, we call the differential the lower time frame bullishness minus the higher time frame. And because the lower time frame is greater than the higher time frame, then this one is going to be positive. And that's how we know that support is then positive, it is then bullish. All right, and now the opposite case, it's the opposite case if you're dealing with resistance. Okay, and in resistance, we need this to be the case. We need the lower time frame to be less bullish or more bearish than the higher time frame. So this is the opposite case. Okay, so let's say resistance is just forming here. This flatlining motion is actually then more bearish than this previous. Is more bearish than this previous uptrend, right? So this is what creates then a negative differential. Negative differential meaning that then if I do a lower time frame subtracting the higher time frame, then I get a negative result, and negative indicates bearish. So hopefully that makes sense. Now so just give me 1 second. I'm trying to get the eraser. Erase. Bigger eraser than that. What the hell is that? Bro. Can we actually not? I clearly don't know how this app works. Can't even delete this. How the hell do you... Okay, that is weird. Let's just get out of the way. Okay, so as I was saying, now we know quantified definitions of support and resistance. Now, can we get quantified definitions of trending states as well? Okay, now trending states, this is how we would define it. We would define the LT being equal to the HT. Lower time frame being equal to the higher time frame. Why is that? Is because if you look at a very strong trend here, it's trending up like that. Trending up. It's the same trend up on the 1 hour as it is on the 15-minute. If there were a differential, then you would be seeing support or resistance forming. But in this case, they're both doing the same thing, and that is actually what creates that upwards trend, or if you might be looking at a downwards trend. Okay, so that is to say, it's the same thing in the downwards trend, right? That the LT still equals the HT. The only difference is that in a downtrend, both of these values would then be negative. They would be bearish, okay? And in an uptrend, then both of these values would be positive here. So this is then how you define an uptrend or a downtrend. There's the differential is then 0 because those values are equal, and they're either positive or negative depending on whether it's an uptrend or a downtrend. Okay, so now we have 3 definitions. We have 3 definitions. Actually 4. Okay, so 4. We defined what is support. We defined what is resistance. We defined what is an uptrend. And we defined what is a downtrend. Downtrend here. Support, I'll just write it here for your convenience. Okay, support is when the lower time frame is greater than the higher time frame. And resistance is when the lower time frame is lesser than the higher time frame. And an uptrend is when the lower time frame equals the higher time frame, and both are positive here. And the downtrend is when the lower time frame also equals the higher time frame, and both are negative. Okay, so that leads me to the next section of this. When I say they are positive or negative, how do I know exactly? Am I still using my eyes on the chart? If it's going down, is it negative? Is it going up? No, again, I encounter the same problem. I'm still relying on my eyes, even though I know these definitions now. Now, how do you solve this? I solve this with the help of something called indicators. Now, indicators are applied to your chart, and they point out things that you could not really see with your eyes. I won't explain in detail how the indicators work or what they do here, but I just want you to know that they're one of the ways of objectively assessing the bullishness or bearishness of price without just looking at it and saying, oh, it's going up, it's bullish, it's going down, it's bearish. Because sometimes it's more complicated than that. Now, maybe I'll go over in another video exactly how to set up your indicators, but for now, let's assume that there are 4 indicators. Okay, let's assume 4 indicators. These are very popular indicators. There's RSI, there's MACD, there's stochastics, and we'll say 4th one, maybe just moving averages, moving average. Now, these indicators may or may not provide reliable signals. Most of the time they actually do. So otherwise, why would people continue to use them, right? So you might be seeing an indicator cross that indicates bullish, or an indicator cross up there that indicates bearish. Whatever the case may be, these indicators still indicate something. They indicate, again, how bearish or bullish something is. So these indicators by themselves are more easy. They're more easy to read than a bear chart. You can read one of these indicators and you can assess, is something bullish or is it bearish or is it in between? So that brings me to my next point, is that we are going to use the help of these 4 indicators. We are going to rate them on a scale of minus 100 being the most bearish, minus 100 being the most bearish, and all the way to positive 100. So that's minus 100 all the way to positive 100. Positive 100 being the most bullish here. And we're not a supercomputer, okay? We can't say like something is it's 70%, it's 78.21% bullish, okay? We can't do that. We're not computers, which is why we still have to use our eyes somewhat. But if you have a trained eye, essentially what you can do is that you can evaluate each of these 4 indicators in terms of how bullish or bearish they are in increments of 25. Increments of 25. So you can rate them in increments of 25, which means you get minus 100%, then minus 75%, then minus 50%, then minus 25, and so on until you reach 100% there. All right. So if you get good enough at reading these indicators, you can easily assign them then a rating from negative 100% to 100%. Now, what do we do with these ratings then? Let's say for a certain time frame, let's say for the 15-minute chart, the RSI gets, we'll give it negative 100, and MACD gets negative 75, because these indicators might be telling you different things, because they also measure different things. But that's actually a strength, that they indicate different things, because we're going to see that in order to average them out, we need to then take the average. So can we add all of these together? So I don't have a calculator, but let's do an average of all of that. Then we'll get the average score here. Let's say it's I can't do mental math, but let's say it's minus 80% or something. That is very bearish, right? And we get that granular number here, which we otherwise wouldn't be able to get just by looking at something. How could you assess MACD and say it's 81.5%? You can't, right? You can only get that precise number by averaging out 4 or even more indicators, which I use to get that final number there. So then that is for one time frame. So we know 15-minute chart, for some reason it is like negative 81% bearish. Okay. So now can we analyze the 1 hour chart? Because like I said, we need the LT here, we need the HT. And how do they compare? Is the LT greater than the HT? Is the HT greater than the LT? Or are they equal? So now we apply the same analysis for your 1 hour chart here. We have the same 4 indicators or more, depending on your preference. Then we average them out. Okay, say your 1 hour average was then I don't know, 25%. Okay, so in this case, your LT is then way more bearish than your HT, which means that then you're looking at resistance, which means that you're looking to sell your instrument. But not only that, you get to know the exact number by which it's more bearish than the higher time frame, and you know that number just by doing basic math. You just subtract them, right? You just subtract them and you get a certain number, and that actually tells you how bearish overall it is, a support or resistance. How bearish is the support? How bullish is this resistance? And that is because you looked at multiple time frames and you also looked at multiple indicators. And this can be chained upwards, right? It can be chained upwards to the 1 hour and the 4 hour and all the way to the daily. I have a very particular spreadsheet where all of this is all programmed out in the formulas in Google Sheets, and that helps me predict it every day. Now you might be asking, what if we're actually in an uptrend or downtrend where the LT then equals the HT? What do we do in those cases? Do we buy it? Or is it the same buying that we would do at support, that you're trying to buy a continuation here? Is it the same buying that you would do if it were a downtrend and then stalling here? Because you would also buy that. You would also buy that if you know this one is support, but this is also an uptrend. So what do you do in those cases? Well, okay. So the thing is, in a continuation, there actually is not as much room to go up than if it were at support here. And that is because if it's at support, it has room to at least go up to the resistance and maybe even break that resistance and go up. Whereas if it's a continuation, well, you're kind of just in the middle of space, right? You're in the middle of space. You have no set target, and then the place where you bought, you actually don't know if it's overbought or whether, let's say you tried to buy at this spot, but actually price decides to be fickle and then it just reverses there and stops you out. So that's why, in my opinion, the continuation doesn't offer as good as a trade as if it were at support there. Okay, so that's why in your continuation you'll find that when you subtract the numbers, again, you'll get 0, and 0 is kind of what we want. 0 is the neutral, and that's why in this case we're treating continuations as neutral. Now, one more thing you can do with this. Okay, so we did say that again, if it's going up, we know that LT equals HT. But we also know that both are positive. Both LT is positive and HT is positive. Now, what do we do with this information? So, in order to know that it's positive, your analysis needed to yield that, for example, the 15-minute got you it got you a 25% rating, and then on the 1 hour, it also got you a 25%. But you know, it's both are positive because you got the average of them. You went like 25 plus 25 gives you 50, and then 50 divided by 2 gives you 25, or it might even be a different number, right? Slightly off, maybe just like 25% and 30%, get the average of that, you still get a positive number there. So that's how we know it's positive. Seems pretty obvious, right? But now, what we're going to do here is demonstrate something, in my opinion, I think is a little cool. Okay, so altogether we have two things, okay? We have, let me just explain this again, okay? So we have LT minus HT. This is known as the differential. And then we have LT plus HT over 2. This is what is known as the average of, you know, the HT and the LT. Okay, so we have two numbers overall. Now, what we're going to do here is we're going to plot this on an XY axis. We're going to plot both of those on an XY axis. So on the X-axis, we're going to plot the differential. We're going to plot LT minus HT. And on the Y-axis here, we're going to plot the average. We're going to plot LT plus HT over 2. So now this is the fundamental core aspect of my strategy, all right? Now what do you do with this XY axis, and what do you do with these numbers that are plotted here? So let's give a simple example, okay? Say we have a point over here. Let's simplify it still, okay? Let's use simple numbers here. So what is this point? Okay, so let's say this is -1, this is 1, this is +1, this is -1, this is the origin, this is 0. So if you remember your grade 9 math or whatever, this point here is known as 1, 0, right? X is 1, Y is 0. Now what does this tell you then? If the X is 1, that means that the LT minus the HT is positive, which means that it's bullish, that we're at some kind of support. Okay, so now what does the 0 tell you then? The 0 is then the average of the LT plus the HT over 2, which means that it's neutral. It's a neutral rating, all right? So we're looking at some kind of support, creating a differential, a positive differential between the LT and the HT, and we're looking at the average being 0. What do we call this? We actually call this a bullish reversal. So we have bullish reversal at this point. Why is it a bullish reversal? It's because this average did not yield something that is either, when after its average, either positive or negative. It yielded 0, right? And then on the other hand, the LT minus HT yielded 1, which means that the LT exceeds the HT. And this is the definition of a reversal. We are not in a continuation state, whether that be a bullish continuation or bearish continuation. However, we still see a bullish differential from the LT compared to the HT. Okay, so we have our first definition there. The definition of a bullish reversal is then this area of you know, this unit circle here, or this Cartesian plane. This area here is going to be known as bullish reversal. I'm going to explain each one in turn, okay? So what happens if we move this point a little bit across the circle, a little bit, we'll say counterclockwise. What happens if this point, imagine it's sticking to the end of the circle. What happens if it moves just a little bit counterclockwise? Then we're at a different angle. So if we're trying to take the angle of this, the angle is 0. The angle then moves, the angle then increases a little bit. And I'll tell you, I'll just give away the answer here of the angle. It's actually 22.5 degrees. It went from 0 degrees to 22.5 degrees. And why is that? Because all in all, I'll just give you the spoiler, all right? All in all, we're dividing 360 degrees into 8. Now, wait, no, sorry, I'm getting my math wrong. No, we're divided 360 degrees. Actually, no, sorry, I'm completely right. Yeah, we're dividing into 8, which gives you then 45 degrees, right? 45 degrees. But we're not dividing the circle as if we're starting here. We're not going like this, okay? We're not going 1, 2, like 3, 4, 5, 6, 7, 8. You know that wouldn't make sense, and that is because the bullish reversal area spans both sides of the x-axis here. It spans a little bit on the positive side. It spans a little bit on the negative side. We can't have it completely being at 0. That would be pointless, right? There's no evaluation that gets completely at 0, and I'm just trying to simplify here. That's why. Okay, but anyway, it gives this tiny slice of specifically 1/8 of this 360 degrees. All in all, that is sorry, I'm getting kind of messy here on my demonstration. All in all, this bullish reversal portion of this circle is still 45 degrees. It's just that it has 1 foot in the positive and 1 foot in the negative. It is still 45 degrees for this slice of the circle. And now if we go around the circle, we can get 8 different market states. 8 different market states depending on the angle that it creates with the origin. And all those points have a significance based on the y-axis and the x-axis and the formulas associated with them. So we know that one is bullish reversal. Now what happens when we go counterclockwise a little bit? Okay, let's take this example again. What happens if we go counterclockwise here? Now we're over here. Okay, so but the question is, we know that let's just clean this up a bit and then I'll explain more. Okay, so we know that this is obviously 0 degrees, right? It's 0 degrees. But if we go a little bit here, yeah, we're going to be precisely, if this was 45 degrees, then on either side it is then 22.5 degrees. That was what I was trying to get at. And if we go another 45 degrees here, then this creates another space, and we call this one bullish value. It's a term I made up. I don't know how accurate it is, but at the time it made sense. If anyone has a better term, you can tell me. But essentially, we went on the circle counterclockwise. We went 45 degrees counterclockwise. But now the question is, how does that value translate both into the formula for the y-axis and the formula for the x-axis? It's not as obvious. And that is because now we have to start delving into trigonometry, unfortunately. Okay, so let me explain the trigonometry. Okay, so here, this is a line that is perfectly straight with the x-axis. Okay, we have nothing to worry about. But what happens if we put the point here? How do we get the y-axis, the distance from this point, which we know is at 45 degrees, How do we get the distance between that point? I keep on writing percent. I meant 45 degrees. The distance to that point to the x-axis, and also the distance from this point to the origin here. Well, that's why we have to go into trigonometry, okay? So this creates a right angle triangle. And this side, the side that is vertical here, we call this, well, for all intents and purposes, we'll just call it the y here, and we'll call this one the x. And then we'll call this one the radius. We'll call this the radius, okay? Now, what we're trying to find here, again, is how bullish is this exactly? We want to know the exact values for y. We want to know the exact values for y and the exact values for x here. And from that, we can know then on a scale of like 0 to 100%, how bullish is this, how bearish is this, and how much of a continuation is it, and how much of a reversal is it. So to do this, again, we need some trigonometry here. Okay, so we know the angle. We know, we actually know the radius. And from the angle and the radius, you can then find both of these values. And the function for that is called the arctangent 2 function. The arctangent would then give you the x and the y. This might not be really used in your high school classes here, but it is actually a formula in Google Sheets. All right, so given the angle, you can then get the ratio. What is the ratio between y and x here? And just from the arctangent, so essentially what we're trying to do here is get the arctangent 2 of 45 degrees, and that is automatically going to calculate the x and y here. So don't ask me exactly how it's calculated. But wait, I'm doing this backwards. Wait. Sorry, we better back up for 1 second. Okay, so sorry, the angle is actually unknown. The angle is unknown. The angle is unknown, but you actually know the x and the y. Sorry, my mistake. Can we back up just a little bit? You know the x, you know the y, and you know those based off of your analysis, right? You just got the values both for the LT and the HT, and then you computed those values into the average and the differential, and that's how you know the x and the y. But we actually don't know the angle here. What is the angle? So that's actually what we're trying to find here. So if the angle is then unknown, then that is when this arctangent function comes in handy. So we're going to compute the arctangent of the known x and the known y, and then that is then going to get us the exact angle, whatever it may be. It may be 45 degrees, or it might be a little bit off. It might be, I don't know, 38.7 degrees, right? But either way, we can get a very precise angle from, again, getting the arctangent 2 of the known x and the known y. And that's what gets you the angle here. Now then, what do we do with the angle? Why do we need the angle to be known? It's because then we can then apply the cosine of the computed angle. So say we found out that angle was 38 degrees plus or minus, I don't know, like there's some decimals here. Let's just imagine it's 38 degrees, okay? So the 38 degrees again was computed from this arctangent function. So now you have the cosine, but why are we using cosine? It's because we have to treat the bullish reversal here. We have to treat that bullish reversal as 100%. We have to treat the bullish reversal as the max bullishness. Like I explained earlier, your continuation phases actually should be treated as neutral, because either the market can just slap you in the face and then end the continuation right then and there, like create resistance and then go down, or it could continue the trend. And that's why your continuations are actually known as neutral, and your bullish reversals are actually should be when it's maxing out. should be 100% for the bullish reversals, and actually like minus 100% for your bearish reversals there. So all in all, if we're taking 100%, we need a function that outputs 100% when the angle is 0. We need a function that outputs 100, or you know, if you prefer 1 is equivalent to 100, right? 100%. We need a function that outputs 1 at 0 degrees. We need the function to output -1 at 180 degrees. That is the area of the bearish reversal there. -1 at 180 degrees, and we also needed to compute 0. We needed to output 0. Sorry, let me just get rid of this trash here. Sorry. Start with a clean slate here. Okay, so we need, again, when x, this is, let's map this function. Okay, so when x is 0 degrees, we need the function to output 1. When x is 90 degrees, okay, I didn't go over this one, 90 degrees, that is known as a bullish continuation at the top of the graph, at the top of the circle, right? When x is 0, y is 1. That is 90 degrees there. When it's 90 degrees, we need the function to output 0. When it's 180 degrees, we need the function to output -1. When it's 270 degrees, we need the function to output 0 again. And then when it's 360 degrees, that is then equivalent to just 0 degrees. We need it to output 1. We need this circle to complete, so to speak, right? So what is this function then? It is the cosine function. The cosine function, okay? I'm not going to explain what the cosine function is or trigonometry. If you're interested, there are, again, tons of tutorials and other math wizards on YouTube to teach that, right? So altogether, the cosine function is what maps to these inputs and outputs. And it looks something like that, right? It looks like that, with -1. Sorry, I meant +1 here, you know, -1 here, and then +1 again. Both of these are zeros, and then right, it starts at 0 degrees, goes to then 180 degrees here, and then back to 360 degrees, right? Cosine function. The cosine function. Everyone loves the cosine function, right? So that is to say, the formula. Oops, what am I doing here? Let's erase. Oh, let's erase all of this. Let's erase all of it. The formula for bullishness is then the cosine of the arctangent 2 of, you guessed it, the x values and the y values, but we know that those can be subbed in with the x being the differential here, the LT minus the HT, and the y, again, being subbed in here, the LT plus the HT over 2, bracket. Let me write that a bit neater for those of you in the back. The formula for, we'll say bullishness or bearishness equals cosine arctangent 2. It's a long formula. Of the LT minus the HT and the HT plus the LT over 2, bracket. That is the formula for bullishness. I think that's a good place to end this video. There are other metrics I also look at, which are known as volatility and delay. Volatility, I use the Pythagorean formula to know exactly where the point is on the circle. So when I did that circle demonstration, right? When I did the circle demonstration, I said the point was always on the edge of the circle, but that's not exactly the case. The point could be very close to the origin, right? And if you remember your Pythagorean formula, that's basically what it counts for. And that is called volatility. If it's very close to the origin, then it is not volatile. If it's very far from the origin, then it is known as being volatile there. So there's that, and then there's also one other measure called the delay. So the thing is, if you're at a continuation phase, you better just order right then and there, because then you'll know if either, actually no, it should be the opposite way around. The continuation means that there should be a lot of delay, because you want to wait till it goes to a point of reversal, whereas if it's a reversal, you want to really buy it right away. I think we should just end the video there, okay? So hopefully that formula sticks with you. If you have any questions, please leave them in the comments below. Am I insane or am I a genius? You decide.